Have you ever thought about how lenders come up with the reserve requirements that they make borrowers hold in escrow? Let me give you some tips about how they calculate those and what you can do to minimize that wasted cash that just sits in an untapped bank account or escrow account with the lender. We're going to go over some of the typical lender reserve types or buckets that they have that you might be familiar with some of them, but I guarantee you're not familiar with all of them. Let me give you a look into some of the lender reserves that we felt were just completely made up when we were closing some loans in the past, and other ones that we thought, sure, that makes sense, but how the heck did you get to that number? So first, we'll talk about the easiest one. When you borrow a loan on a real estate property from a lender, they're typically going to say, look, we want to escrow or hold in savings the amount of money for property taxes. And the reason they want to do that is because property taxes are more superior than the lender's mortgage position. Meaning if you don't pay property taxes and the county comes in and forecloses on your property, it literally negates and wipes out the lender's mortgage. So clearly the lender doesn't want that. The way they protect from it is they hold property taxes in escrow. This happens on single-family home residences that you may live in, and it also happens on commercial properties. Pretty standard and straightforward. The tricky part on this particular escrow reserves is that some lenders say, hey, I want a full year of property taxes paid up front, and every single month I want you to reserve for the second year. So one of the negotiating points you can do is tell the lender, look, I don't want to put 13 months of reserves up. That's a lot of cash that I could use for other things. So sometimes you can negotiate instead of a year paid in advance and then every single month, maybe you only put 6 months of property taxes in reserve and then you pay monthly after that out of your regular payment. So just some way that you save a little bit of money as a sponsor or an investor in properties, all add up over time. We'll go through several reserves and you'll see if we add a little bit savings on the first one, a little more savings on the second, etc., you end up with a lot less capital you need to put into the deal. So let's talk about a second escrowed reserves. This one's pretty common, property insurance. Similarly to property taxes, a lender will want to make sure the property is well insured. And while the lender gets recorded as a mortgage payee or loss payee on your property insurance, they also want to make sure if you ever don't pay your monthly insurance and they don't see that right away, and if a massive hazard were to happen or peril, like a fire, a flood, wind damage from a hurricane, they want to make sure the property is fully insured for replacement value so they're not stuck with a loan on a property that's really damaged. So the way they do that is they say, hey borrower, you need to pay insurance in advance and you also need to contribute every single month more money for the renewal of the insurance. Sometimes you can pay insurance with installments, either monthly, quarterly, or semi-annually. Oftentimes the lender will say, pay it all in one lump sum in advance, make sure you've covered the whole year's insurance. And so again, the lender is going to say, pay it a full year's policy up front when you buy the property and take out the mortgage, and then every single month add more to this escrow account. It's just a drain on cash. So if you can get your insurance company and your lender to agree that you'll pay over time and you don't have to escrow as much money, it's better for you and it gets a higher cash on cash return for your investors, a higher IRR, and eventually a higher multiple on invested capital. So those two escrows and reserves are pretty basic. Now we're going to go into some that you may not be as familiar with, particularly if you're a newer sponsor in commercial real estate. The third one I want to talk about is a required reserve for repairs. You see, oftentimes when lenders are going to lend you money on a commercial property, they'll say you need to do a property condition assessment or get a property condition report. It's great for you too as the investor because you'll know everything about the building that needs to be fixed. Whether it's the roof, it's the asphalt in the parking lot, it's the boiler in the basement, it's the air conditioning units, whatever it may be, that's really helpful. And so for you as an investor, it's great. But here's the tricky part with lenders. Hey, sorry to interrupt. I just want to let you know we drop new content all the time. So go ahead and hit subscribe. You'll be first to be notified we've got something new that comes out. Whether you're interested in our real estate investment tips or business ideas like AI. Now, back to the video. Lenders will often say, hey, Based on the property condition assessment, there's a report that says there's immediate repairs that need to be done, sometimes called deferred maintenance. And that might be, let's just say there's some cracking in the asphalt, and there's some repairs on the roof, and there's some, weathering that needs to be protected from. So let's just say, for argument's sake, that's $100,000. So the lender will often say, look, we know you're going to repair these after you close on the property, but we don't want to have to chase you to do them. So what you need to do is put $100,000 in this deferred maintenance escrow account, and then as you get contractors to do the work, we'll release the money to the contractors. That's fine, relatively straightforward, probably helps your investors, no big deal. Here's the part you want to watch out for. Oftentimes, the back of the property condition assessment report, there's a table of what's going to be needed immediately, then in year 1, year 2, year 3, sometimes it can go out 10 years, of what the engineer that does the report is estimating is going to wear out or need to be replaced. And lenders can get pretty aggressive and say, look, we want to escrow 3 years or even 5 years of money that you're going to then use for repairs over time. That's a ridiculous waste of cash from either you as the sponsor or your investors. So you certainly want to negotiate with lenders and say, look, I'll put the immediate repair money in escrow, but years 1, 2, 3, 4, 5, I'll fund that over time. And so that's a way you can negotiate less money stuck in escrow being really illiquid and a drag on your cash on cash and IRR. So look out for those when you do your property condition reports and property condition assessments. The other category that's often not as well known for people that are investing in maybe some of their early commercial real estate, particularly on the commercial side, are for tenant improvements and leasing commissions. Sometimes these are called good news escrows, because it's good news that you've leased up more space. So let's say whether you're buying a retail building, an industrial building, hospitality asset, or even an office building, the lender's oftentimes going to want to know that you've got cash to do the tenant improvements so that that tenant will be happy with the space, because you're going to give some concessions as the landlord, and you're going to put in walls, you're going to put in some maybe cubicle space, offices, glass, doors, whatever you're going to build out. You can imagine in a medical office space, you're putting in a lot of tenant improvements, and oftentimes in your marketplace, it might be typical that the landlord pays for those in order to get a long-term lease, sometimes at a higher rate. So the lender is going to say, look, you've got a reserve for those. Right now, let's just take an example. You've got a 100,000 square foot building and it's 20% vacant when you buy it. That 20% of 100,000 is 20,000 square feet. The lender oftentimes is going to say, look, for tenant improvements in our market, that's $35 a square foot. So they're going to multiply that 20,000 square feet of vacancy times $35 square foot of tenant improvements and say, we need you to escrow all that money. That's a lot of money to be sitting there. And so whilst you can negotiate with some lenders, some more than others, you want to be aware of how much you're negotiating. Sometimes you can say, look, we don't think we're going to pay the full market rate of $35 a square foot. We're going to only pay $20 a square foot. And we've got independent third-party brokers that are doing leasing in this market to validate that that'll still be reasonable. And so you can negotiate for a smaller amount of tenant improvement reserves to be held. The other thing you can do with the lender is say, look, we want to contribute a little bit every month towards future leases that come up for renewal. We don't want to plunk it all into a escrow account for reserves early on, which again means you've got to raise more money or put more capital in there, which overall decreases your cash on cash return and your IRR. So what you do is you negotiate with lenders on these. The other thing that the lenders typically say is, look, same example, 100,000 square foot building, 20% vacant, that 20,000 square feet, they're going to say, when you do lease this, you're going to have to pay leasing commissions. And we don't want to have to, as a lender, worry about, do you have the money or not to pay the leasing brokers? So they'll oftentimes say, we want you to put that in a reserve. And that can either be a percentage, maybe it's 3%, 4% of what that space will lease for that you're going to pay to a leasing broker, or in your market, it might be a certain dollar per square foot. It might be $3 a square foot, $5 a square foot, etc. That's kind of market dependent. But the lender may say, you need to escrow those funds and sit there in an account. Again, we'd advise you to negotiate those to say, look, let me escrow some of them, I'll have the others held with me, or I'll contribute it later, or I'll add to that escrow account over time. But these reserves, especially if you don't know what they are and you get towards closing, you've raised your money from your investors if you've syndicated a deal, or you've raised your money from friends and family if you're a smaller sponsor or an emerging manager, and now you go to closing and the lender goes to the title company or the escrow company and says, by the way, we need an extra $500,000 of reserves. This happens all the time. So to avoid this problem, you want to first of all be aware of it. Secondly, you want to negotiate in advance with the lender so you don't get this surprise $500,000 request at closing and you're scrambling to find the money to get everything reconciled so you can close the property. So those are really helpful to know, and certainly lessons we learned the hard way. The other couple things that may pop up as reserves in commercial investing when you've got a lender involved, which is most of the time, are the next category would be interest reserves. So sometimes they say, like, look, you're going to pay our mortgage every month, you're going to pay this, but if the property is 20% vacant and it falls beneath, 25% vacant, meaning there's more vacancy than 25%, we're going to want you to contribute payments into a reserve. Sometimes it's referred to as interest reserves, particularly if you're only paying interest, like interest only duration in the beginning of a loan. Other times it can be principal and interest both as reserves, but they sometimes will ask for that. And so you want to be aware that that's a category lenders will ask for, and be prepared to negotiate that you don't have to do it, or if you do need to do it, try to spread it out over time if your building becomes more vacant than the lender's comfortable with. When you're doing a value add deal, it's often pretty typical that a lender will say, we want a certain number of months payments reserved in escrow, 6 months, 12 months, etc. And all these escrows, if they're a surprise at the last minute, are sometimes almost a deal killer. So you got to be aware of these, and then you got to obviously raise the capital for it. So be aware. The last category I'll just throw into miscellaneous reserves that we've seen lenders literally at the 11th hour, 1 day, 2 days, 5 days before closing, they say, hey, our loan committee's decided that we want these other reserves. And at that point, particularly if you've signed exclusivity with that lender, which we would advise in another video how to avoid, you might be really against, a tough spot and have to find that money. So a few other categories that lenders pop up at the last minute. Capital improvements. Sometimes they say, look, the building's fine, you've reserved for deferred maintenance, you've reserved for replacements over time, but we as a lender have just decided that you're going to need to redo the lobbies, redo the common area bathrooms, redo the facade, redo the signage, and so those capital improvements, we want you to escrow for those. And that can be hundreds of thousands, if not millions of dollars. That can really kill your deal. Now at that point, the problem is you've probably got non-refundable earnest deposits, you've paid all kinds of third-party report fees, you've told your investors you're closing the deal, and lo and behold, the lender shocks you with this crazy reserve for capital improvements. So make sure you're aware that it exists and how you can negotiate against having them. And if you do need to have them, see if you can spread out the payments that contribute to capital improvements down the road in the reserves slowly. Other two last ones I'll leave with you. FF&E, so furniture, fixtures, and equipment. Sometimes you've got hospitality assets. There might be something like a PIP where you've got to have a reserve that you're going to replace furnishings and countertops and just hard finishes on the inside of your property. That might be something that they make you reserve for, so be aware of that. And the last one is one that can really hurt you, which are springing reserves, meaning there's not a reserve now, but if something changes with the property, like your occupancy or vacancy rate, or the cash flow, like your net operating income is different in the future, sometimes lenders will have this springing reserves where all of a sudden you've got to kick in hundreds of thousands of dollars or even millions of dollars to a reserve because the property's performing differently than they first underwrote. So you want to see if you can negotiate those out of your loan agreements whenever possible. So those are from the most basic reserves from the lender's requirements of property taxes and insurance to the more esoteric reserves for springing reserves or different things. So I hope this helps you prepare mentally for your negotiations with a lender on reserves and make sure that you're properly capitalizing your deal, whether you're putting in your own capital or you're raising money for your deal. Make sure you've got this in your calculations so you don't get surprised, it doesn't kill your deal at the last minute, and when you do need reserves, that you've underwritten it so your cash on cash pro formas and your forecast of IRR, internal rate of return, and your multiple on invested capital take into account these particular reserves. This will make sure you've got a successful deal and no one's being surprised, because I tell you from experience, investors hate surprises and you want to do your best as their advocate to avoid surprises throughout your whole deal. Hope that helps. Don't forget to refer us to some friends and share this video by clicking the share button below. See you in the next one.